Hi, students. Welcome back to class number 21 on CMA and financial management. So we are in chapter number, which means the concept two. First, we saw in detail about what is the marginal costing and associated problems on decision making, and then we came to budgetary and budget control. And last two classes, please don't miss that was released on budgeting and budgetary control, and now we are continuing the class on budgeting and budgetary control. I think there should be only one more class for on budgeting, and we will move to the standard costing very shortly. So let me move to today's topic. I have selected few questions which are little bit rare, and most of the problems I am solving only the very similar problems I am asking you to solve, and you can drop your comments if you have any doubts on that. So let us go to today's problem, which is illustration number 7 as per your PDF study material. XYZ Limited produces two products X and Y and operates three sales division for the sales of their product. Prepare sales budget for 6 months ended June 2016 from the following information. Okay, so we have to do the sales budgeting. Okay, and some information is given for us. So what is the information? Budgeted sales for the 6 months ended. So for the last 6 months, what is the budget? That detail is given to us, and what we have to do, prepare the budget for the next 6 months. Okay, so we have completed the 6 months as of now, and for the next 6 months we have to do the budgeting, and we have been given a data of last 6 months data. So what is the budget that is given? Product X and product Y. There are two products, and two products are sold using three sales division: division 1, division 2, division 3. There are three sales division. Here they have clearly given what is the quantity. 1600 quantity is sold through division 1 at 10 rupees. Okay, and product Y also they have given this detail. Actual sales during the same period. So for the last 6 months we have the budget, also we have the actual sales data also. Okay, so actual sales, the quantity is also different. That makes sense. Price is almost same as the budget. Okay, so budgeted price is same, so there is no change in the selling price from the budget that is planned for the last 6 months. In the management meeting, the following decisions have been taken. So now, before you are going to make the sales budget for the next 6 months, the following decisions has been taken by the management. So what are the decisions? The price of the product X should be increased by 1 rupee, as there is a high demand for the product. So you can see here, product X 1600 was the plan, but 2000 was sold. And in division 2, 2400 was the plan, 3200 is sold, which means the X is always getting sold more than the plan. What does this mean? This means there is a huge demand for the product. We can make use of this opportunity, and we can little bit price it more. Okay, and we can get little bit of profitability. We cannot go too much of pricing also, but we can make use of the opportunity. Since the actual is more than the budget, so we can little bit increase our prices. So that is what is a suggestion, and increase of 1 rupee is suggested by the management. Next decision by the management is product Y is not selling at the expected rate, as this product has been overpriced. However, if the selling price is reduced by 1 rupee, it is expected that the market would pick up. Therefore, the divisional sales manager has the following estimate. Okay, so what if you see product Y, last 6 months budget was 800 for the division 1, but actually it was sold only 400. 4800 for division 2, but only 4000 is sold. So what does this show? Y is getting sold less than the budget, so less than the target. So budget is target, so less than the target we are selling. What does this mean? There is a demand, but the demand, the people are saying that this is very costly, so we are going to reduce the price for it, as suggested by the sales manager. Finance department is not expertise to take this decision, but sales manager has given this decision, so we can just see if that is viable or not. So we are going to reduce the price by 1 rupee for product Y and increase the product X price by 1 rupee. These are the two decisions. So price point of view, yes, we have the data. So we have to make the sales budget for the next 6 months. Sales budget need two things, selling price and the sales quantity. So we are sure about the selling price because product X 1 rupee increase and product Y 1 rupee decrease. That we are sure about it. And next, what is the thing? With this, the sales manager has given the following increase. So percentage increase over the last 6 months budget. How much percentage your sales will increase by doing these two suggestions given by the sales department. Okay, now I am plotting this last 6 months budget. I am just plotting it. So 1600 quantity at 10 rupees is sold. So 1600 into 10 is 16,000. And at division, so division 1, division 2 and division 3, this is for the product X. So if you see product X, 1600 into 10, 2400 into 10 and 2400 into 10. Okay, so 2400 into 10 is 24,000 and 24,000, putting together the total sales of 64,000 for the product X. And for the product Y, in the same way I have plotted, the total sales revenue coming is 68,400. This is as per the last 6 months budget. Now what we have to do? We have to do the next 6 months budgeting. For that, we have to incorporate the new data that has come in. One is the price increase, and second, because of that decision, sales volume is going to increase. Now sales volume, it is given 20. Now let's plot for the product X alone. So product X, 20% sales volume will go up. Okay, 30% will go up and 10% will go up respective divisions. Okay, so I have given what is the increase. So current division 1 sales is 1600. It will go up by 20%, which means it goes up by 320. So 1600 plus 320 is 1920 will be the new sales. Similarly, division 2 last 6 months sales is 2400. It will increase by 30%. 30% increase is 720. So 720 plus 2400, it is 3120. 3120. So 2000, and same way apply this increase. So you have found the new quantity. What does sales budgeting need? Sales budgeting need the sales quantity and selling price. So sales quantity, whatever is the increase, we have applied and we have found the new sales quantity. And what is the new selling price? There is a huge demand and we are going to increase the price by 1 rupee. The price as per the last 6 months is 10 rupee for the product X. Now we have increased it to 11 rupees. Now we have the sales quantity, we have the selling price for every divisions. We can multiply and we can find the revenue that will be generated, which is 84,480 compared to 64,000 for the last 6 months. So the next 6 months budget is, the target is much more tighter. You have to achieve the revenue of 84,480. Same way you can do the same math for the product Y. The quantity increase percentage is given here. Price reduction is given. So price as per the last 6 months is 9 rupees. But now we are reducing by 1 rupee to 8 rupee, and you can do the same math. Your product Y revenue will be 66,240. So even after reduction of price, our sales revenue of 68,000, that is budgeted sales volume, sales revenue is going down, which means product Y, the sales is falling. So management has to do some facelift for the product or doing more features on the product to do some more sales. Okay, so this is what is the problem. We have plotted the sales budgeting for the product X and product Y for the next 6 months. Okay, so let's move on to the next problem. Draw up a flexible budget. So students, we discussed about what is flexible budget. So flexible budget is something like we are not fixing the at only one point of activity. We are fixing the budget for 2-3 set or level of activities, so that it is flexible. For example, when the actual happens, we can compare the actual with the appropriate activity level budget. Okay, in this problem you are going to see various activity levels. Okay, draw up the flexible budget for the overhead expenses, not for the complete P&L, only for the overhead portion the question is asking. Following data is given. Determine the overhead rates for 70%, 80% and 90% capacity utilization. company, if it operates with 70% capacity, 80% capacity, 90% capacity, what will be the budget? We have to plot that. That is what is the flexible budget. So always the flexible budget will have these kinds of various budget scenarios for various capacity levels of activities. Now when the actual happens, an actual capacity utilization, for example, is 68%, very near to that is 70%, so they can compare the actual with the 70% budget. But if you have done the budgeting only for the 100% capacity, just think you are operating at 50% capacity, you have to compare the actual with the that will be there will be a lot of difference, and it will be very difficult for you as an accountant to plot it in detail. But in that case, if you have a budget for 50%, 75% and 100%, and when your actual capacity utilization is 50%, you can compare your actual with the 50% capacity utilization budget. That makes your variance analysis lot more easier. Yes. So the detail is given in the question for 80% capacity. So 80% capacity overhead expenses are given. What we have to do is, for 70% what will be the budget? For 90% what will be the budget? We have to plot that. Okay. So the first thing is the variable overhead. We should not have any doubt in variable overhead, because we have seen this type of problem lot in our marginal costing discussions itself. So here I have plotted all this. So variable overheads is given as indirect labor 12,000 and stores including spares is 4,000. So variable overhead varies with the capacity utilization. It is very simple. So 12,000 is the variable overhead at 80%. So for at 70%, what it is going to be? So divided by 80% multiplied by 70%. This is what is the formula which we are using even in the marginal costing chapter. You can see one in our previous videos of chapter number 1, marginal costing. We are applying the same. Okay, so 12,000 divided by 80%, we are going to get the variable overhead for 1%, and multiplied by the 70%, we are going to get the 70% what will be the variable overhead. You can apply the same for the stores and spares also, because that is also given as variable overhead, and you can apply the same formula for 90% also. For plotting the 90% also, divided by 80% multiplied by 90%, you can plot the variable overhead for 90. So it is directly proportional or linearly proportional. So as and when the quantity increases, the cost increases. That is what is the variable cost. So for every unit of production, the cost will go up. So that's why this is directly proportional, and we can directly apply this max and find it. So next we have finished this discussion on the variable overhead, how to plot for the various capacity utilization. Next, the challenge is going for the semi-variable overhead. So what is the semi-variable? Semi-variable means it is partially variable and partially fixed. So what we have to do, we have to split the variable and fixed component, and for variable we have to apply the same logic which we applied for the variable overhead, and for the fixed we have to retain it as constant, because it will not change with the level of activity. Fixed cost will be constant at all levels of activities. So now the power expenditure is given as 30% is fixed, 70% is variable. So 20,000 is the full amount. So on the 20,000, which is for the 80% capacity, I am applying 70%, and for the 70%, I am going to apply the same mathematics or same formula which we applied for the variable overheads. It is divided by 80% and multiplied by 70%. So the 70% component, variable component, I have translated to the 70% capacity. Now the remaining 30% is fixed. So 30% of 20,000 is going to remain constant. So I'm just adding 30% of 20,000 as constant, but 70% of 20,000 is at 80% capacity, has to be converted to 70% capacity. That can be done by dividing by 80% and multiplying by 70%. Apply the same for the repairs also, but it is 60% fixed and 40% variable. So apply the same logic for converting to the 90% capacity also. You can use the same logic. Now you have plotted the semi-variable cost also for the 70% and 80% capacity. Now we are going to the our last topic of discussion for this problem, which is the fixed overhead. Fixed overheads will be constant irrespective of the unit of production, which means the material, for example, depreciation of the machinery is going to happen, and that was going to be constant for the comparative periods or comparative level of activity. It is going to be the constant. Insurance, okay, insurance premium what you pay for the asset, or you are insuring the asset or whatever it is going to be the constant, and they have given it as fixed. Okay, which means at 80% it's going to be the same, at 90% it's going to be same, and even at 70% it's going to be the same. So for the fixed overheads, whatever we have in the question we have got for the 80%, we are going to take the same number for the 70% also, and same way we are going to take the same for the 90% also. Now you can total all the overhead, and in the question for 80% it is given as 62,000, and this comes to 70% capacity, it comes to 58,150, and for 90% capacity it comes to 65,850. Okay, now the direct labor, estimated direct labor hours is given. Direct labor hours is also variable in nature, so we have to apply the same mathematics we have applied for the labor overheads. What is that? If you want to plot for 70%, divided by 80% multiplied by 70%. So I am doing the same logic and finding the direct labor hour required for the 70% scenario, and same way I am applying to find for the 90% scenario. Now we have the direct labor hour also. If you want, you can also plot the overhead direct labor hour. So overhead plus direct divided by direct labor hour, we can find it if it is required, if it is asked in the question. So this is what is discussion on this problem. Hope you are very clear. I think I have one more problem for discussion for the day. Okay, so I have not worked out in detail this problem because this is very easy, and we are discussing this type of problem right from our marginal costing topics. The profit for the year for the push on limited works out to be 12.5% of capital employed. So capital employed figure should be taken, and 12.5% of it is the profit for the year, and the relevant figures are as under. So 5 lakh of sales, 2.5 lakh of material expense, labor expense of 1 lakh, and variable overheads of 40,000. So putting together, 4 lakh is the capital employed, and we have earned a 12.5% of profit on the capital employed, which is 4 lakh. The new sales manager who has joined the company recently estimates for the next year a profit of 23% of capital employed. So the new sales manager has come in, and he is saying from 12.5% in the current year, for the next year we can improve it to 23% of capital employed, provided the volume of sales is increased by 10%, and simultaneously there is an increase in selling price of 4%. So the sales manager suggests to increase the profit from 12.5% of capital employed to 23% of capital employed. Okay, how this can be achieved? By increasing the sales volume by 10% or sales quantity by 10%, and selling price should be increased by 4%, and overall cost reduction in all elements of cost, there is no doubt. So let it be direct labor, direct material, variable overheads, or even fixed overheads, all element of cost, we have to cut the cost by 2%. So if we do this cost cutting, selling price increase and sales quantity increase, then we can achieve 23% of capital employed as our profit. Find out whether this proposal can be adopted or not. Okay, so current year what is the profit? So 4 lakh is the capital employed, 12.5% is the profit. So we can apply the 12.5% on 4 lakhs and find the profit. Now you have the sales revenue, you have the sales revenue, and you have the profit. So if you reduce the profit from the sales revenue, you are going to get the total cost, which is nothing but the fixed cost plus variable cost. Okay, so variable cost is already given in the question. So you can find the total cost, you can find the variable cost which is given in the question. So total cost minus variable cost, you can find the fixed cost also. Yes. So we have found the fixed cost also now. Okay, now what, because we have to reduce the cost by 2% for the next year. So for that we have to find the fixed cost. That's why we have found the fixed cost. Now we have to plot the next year how our marginal cost will look like, how our sales revenue will look like. So the new sales from the current sales, what we are going to do, we are going to increase the selling price by 4%. So 5 lakh of sales is going to increase by 104%. We are going to increase by 4%. Also the sales quantity is going to increase by 10%. So the current sales of 5 lakhs multiplied by 110% multiplied by 104% will be the new sales, because sales is the product of quantity and selling price. So quantity is going up, selling price is going up by 10% by 4%. So we are multiplying by 110% and 104%. We have the sales figure. Now we have all this direct material, direct labor and variable overheads, putting together the variable cost, and the variable cost has to be cut. All the costs are reduced by 2%, but variable cost is a cost which increases with increase in the quantity. Now we know the sales quantity has increased by 10%. So the current variable cost, which is 2.5 lakhs plus 1 lakh, which is 3.5 lakhs plus 40,000, 3.9 lakhs of variable cost has to be multiplied by 110%. Here is where the most of the students does the mistake. They just multiplied by 98% because the question is saying 2% cost reduction. So here is where we have to be very careful. We have to first increase the quantity. Okay, here this is the this is for the lesser quantity. Now the quantity has gone up by 10%. So 3.9 lakh variable cost multiplied by 110% and multiplied by 98% for the cost cutting. Yes, and fixed cost, there is no doubt, whatever is the fixed cost that we have found for the previous year, that multiplied by 98% is going to be the new fixed cost. Fixed cost will be constant. However, we have done some lot of controlling measures as a finance people, and 2% cost cutting as suggested by the sales manager we have achieved. So we are taking that as a fixed cost. Now you have the sales, you have the variable cost, you can find the contribution, you have the fixed cost. Now you can find the profit, and you can verify whether the profit is equal to or greater than 23% as said by the sales manager. If that is yes, you can adopt that. And one more information is illustration number 10 was given to plot the full year budget with the details given in the question. That looks like only the mathematics and presentation in the tabular format. So I think that is very easy for you to understand from the study material itself. So students, let me meet you in the next class with the last topic on the budgeting. With that we can close the budgeting and we can move on to the standard costing. So all the very best students. Bye bye.